So now time changes and another year goes by, and Special Foods earns net income of $75,000 and pays its parent, Peerless Products, dividends of $40,000. So the journal entries to do this would be, again under the equity method, debit investment in Special Foods, credit income from Special Foods, then I have the dividend of $40,000. And so I debit cash for $40,000, and then I credit the investment account for $40,000. Now, then I got additional expenses. So we go back to our write-ups and we think about what's happened to these. Now, what's happened to these is the inventory is gone. We wrote it off last year. The land is just sitting there. It's still the $10,000 write-up is in the land, and I'm going to need to record it in my spreadsheet. But that doesn't need to be expensed because you don't depreciate land. And this buildings and equipment write-up is still there, and I'm going to need to depreciate it. So it's a $60,000 write-up that needs to be depreciated over 10 years. So that's going to be, again, $6,000. $60,000 divided by 10. $6,000, and it's not debit depreciation expense credit accumulated depreciation, because that's not where the parent recorded the income. The parent is using the equity method and is recording income like this. So if the parent has additional expenses, then they're going to need to take it out of there by debiting income from Special Foods for $6,000 and crediting investment in Special Foods for $6,000, like so. And now again we do our consolidation. Now another year has passed. What do you think depreciation is on the books of the sub now? Let's take a look. It's $340, right? Because it was $300 on the acquisition. They recorded $20,000 in depreciation expense last year. So that brought up accumulated depreciation to $320. And this year they record another $20,000, so that's going to bring up accumulated depreciation to $340. We'd start off with our big elimination entry. So I'm going to debit consolidated net income. I'm going to debit income from Special Foods for the reported income of the sub of $75,000. I'm going to debit the beginning retained earnings for the balance of the sub, $120,000, and I'm going to credit dividends for dividends paid by the subsidiary to the parents. I'm also going to debit common stock for $200,000, and the plug between all of these, that'd be 75 plus 120 minus 40 plus 200 is going to be a credit to investment in Special Foods for $355. There you go. Next, I'm going to adjust my income statement. And I don't have to worry about the inventory. I don't have to worry about impairing goodwill here because there's no impaired goodwill. All I've got is additional depreciation expense of $6,000. So I'm going to debit depreciation expense of $6,000, and I'm going to credit income from Special Foods also for $6,000. And I look and see as you're doing work, it's always a good practice to see if everything makes sense. And consolidated net income of Peerless, if they're using the equity method properly and they're adjusting for it with these third entries here that I've been showing you, then reported income, consolidated net income on the books of Peerless is going to be equal to consolidated income on our spreadsheet. Now, if Peerless, we said Peerless can use another method. They can use the cost method. They can use something called the dirty equity method, where they don't do these adjustments for the write-downs. If so, then that's not going to be equal. But this is equal, so we're happy, and income from Special Foods has been eliminated down to 0. Next, we do our additional write-ups. So originally I wrote up inventory, but the inventory is gone, so I don't have to write that up anymore. I've got some land here, and the land needs to be written up by $10,000. The buildings and equipment needs to be written up by $60,000. I'll get to the depreciation in a moment. and I need to record 2 years depreciation on here. That would be last year's depreciation of 6,000 plus this year's depreciation of 6,000, or 12,000 in accumulated depreciation. I've also got to book this goodwill. So goodwill was cut down to $9,500. So therefore I'm going to debit goodwill for $9,500. And the thing with these entries is these are not traditional journal entries. Traditional journal entries you record in a journal and then they go to a general ledger. These journal entries here just stay on the spreadsheet because they can't go on any general ledger. They affect two different companies. Some of the debits and credits apply to one company, some apply to another. So you can't put them on any one set of books. Instead, they're just going to be recorded in this consolidation. So these are my adjustments to the balance sheet. I'm going to have one more in a moment. And I'm going to get a credit 67.5. And I'm always very excited when I see this investment account go down to zero. And then I've got the accumulated depreciation entry, which is again 300,000. Now, why isn't it going up? Every year, the amount of accumulated depreciation on the books of sub goes up, but the accumulated depreciation elimination entry stays the same every year. The reason why it stays the same is because the company, this is the amount of accumulated depreciation on the date of acquisition. And when the parent bought the sub, it's like a new company. It's like a new company. It's like new stuff. So any accumulated depreciation that existed on that date needs to be eliminated. Accumulated depreciation that was recorded after that date is recorded by the new consolidated company so it can stay on the books. So of this 340, 300 was there when we bought the company and needs to be eliminated because it no longer applies. We bought the company and everything is like new. But the additional $40,000 that we recorded since we bought the company is still legitimate accumulated depreciation, and therefore it's going to be recorded. So this is a 2-year example. And what I find helps students to learn this the best, because there's a lot of detail here and there's a lot of things to remember. So what I find really helps students to remember this is to do it a lot. So go through the exercises carefully. I've posted practice exercises too. Go through those practice exercises and spend time on this. You should be spending about, I would say, 5 or 6 hours between the homework and exercises. Maybe less, maybe 4 or 5 hours with the video. About 6 hours for a week working on this and just going through it. Go through it step by step. Do one problem at a time. Look at it carefully. And just practice it. And what you'll find after a while is that it just starts to come together and that you're able to do it. And again, one other piece of advice is check your work. In other words, don't just click the button that says check your work. The real world's, unfortunately, life does not have a check your work button. I have to put that in my book. I'm writing a book, Chicken Soup for the Accountant's Soul. And so that's a good thing. I never thought of that. I should put it. Life does not have a check your work button. Anyway, life does not have a check your work button. In real life, you have to check to make sure the assets equals the liabilities plus stockholders' equity. You have to make sure that debits equal credits. See there like that. And work through the details of these spreadsheets very carefully. Debits don't equal credits. So what's wrong here is that retained earnings is not carrying down from the retained earnings statement. I bet I made the same mistake up here. Let's see. Nope, that's good. See there, you check your work and you find mistakes. So look at your work very carefully and make sure that the details are there and that you haven't missed anything.